Recently, the federal government, in a bid to revamp the mortgage industry in Nigeria, established the Nigerian Mortgage Re-financing Company. At the just concluded Africonomie Summit 2014, Mr. Sonnie Ayere, Chairman of the NMRC, engaged stakeholders in a Q&A on the operations, viability, and efficiency of the company in tackling the mortgage and housing issue in Nigeria.
For someone who's not so familiar about it, what the genesis of the Mortgage Re-finance Company is and the history beyond it, and how it's funded as well?
All right, good question. So we start from the history. It came about, there was, I don't know if anybody here was there, there was a presidential retreat on housing sometime in, it was about October 2012. And it happened at the Azurok in a banquet hall. And the idea of it was basically to say, how do you crack the problem of housing in Nigeria? And we looked, there was I mean, if you can, I don't know if anybody here has been at the banquet hall, it's a huge hall, and it was full, right? And more importantly, it had the president, the vice president, the minister of finance, the central bank governor, everybody to do with housing, etc. Then it was Amma Pebble, the former housing minister. Everybody was there anyway. And it was a full day, starting from about 9 a.m. It ended about 6 or 7. We had breakout sessions. Can you imagine the president attending breakout sessions? Right? Seriously. Different breakout sessions. There were issues, people who were looking at the construction side, people looking at the finance side, people looking at materials, etc., etc., etc. And it was sort of managed by McKinsey's. And a poll, sort of like voting sort of poll thing was done at the end of it. What was the most important thing? It then turned out to be finance. All right, that had the highest poll. And that's what gave birth to the idea of having a refinance company. But nevertheless, one needs to take cognizance of the nuances of what we have to make sure that we're not unduly exposing ourselves to risk, because last card check, this is a confidence business. So that's kind of like the way we expect it to be, sustainable. But again, I dare say the sort of money that is required for this market cannot just come from the domestic market. If we look at the numbers, if we're successful in making this work, it is important that it's not just a financing thing. There are other issues. We've talked about it, we've seen that in papers, etc. Title, foreclosure, all these sort of issues that surround housing. That if we don't get right, the amount of money that would trickle into the sector would not actually have the impact that we want to have. And therefore, what we've done was also to expand the scope and say, okay, well, financing is one thing, that's good. But in Nigeria, as you know, if somebody takes a mortgage and they default, to repossess that property is a nightmare. So how do we go around that? So recently, Tosin would be there to say, we've just applied, or we've hired 6 top lawyers or law firms to come up with a model mortgage law, mortgage and foreclosure law. The idea is that we have something that can be passed by the states. For those who follow the story, we've had pilot states that we're working with, and what we want them to do is, as part of the financing that we want to provide to your states, we also want you to pass this law to allow for foreclosure, and more importantly, also to improve, or let me say, re-engineer the titling system.
Why you're also working to have a strong, foreclosure legal framework. So what sort of arrangement are you making us to help some of these workers that some volatility could just happen to their work and they lose their work? So my question to you is, what sort of insurance protection are you going to bring? So those are the questions. Thank you.
Let me answer those then. Let's start with the CMO. That's, in Africa they say you don't eat an elephant once. If you enter mouth, go tear mouth. So the idea is that let's start, with something simple. And I mean, it's a natural progression, as once you get the right mechanics and it starts to flow, it's inevitable that you now start looking at maybe investors now say, okay, we want this sort of duration, blah, 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 et cetera, et cetera. That will happen. Then in terms of the training, again, the market, we don't have pools for which we can, seasoned pools, where you can start saying, okay, what's the CPR, on the mortgages. Now, that's the kind of thing that we would begin to, for instance, I give an example. Sorry, this is again conversational detail here. We're working on, again, the technology, right? Where the idea is that we want to have, it's like a mother-child interface structure. So we're able to interface with all the mortgage banks, so that we can now start having an idea of what, say, for instance, 30-day delinquencies are. So I can aggregate 30-day delinquencies across the market and say this is average 30-day, or 60-day, or 90-day, or even charge-offs. Then we can now start having an idea of what prepayments, average or constant payments are, so that you can actually start using, certain CPRs for computation. But that would happen over time. We can now start looking at mortgages from, cohorts, and saying, okay, let's look at, the 2015 vintage, let's look at the 2016 vintage, how that's performed, etc. All these things will come over time. But the most important thing is that because at least we know what we're looking for, we can create the architecture from day one. All right, that was kind of like a conversational detour, just to let you know that the technology we put in place is there to capture that kind of information you're talking about.
Talk about the unemployed, because the truth of the matter is, I don't know how many employed people we have in Nigeria, really, in terms of the number of people that require this housing shortage. What I've seen over the years in my 7 years mortgage experience actually is that the thinking line for every Nigerian is whenever they come to take a mortgage loan, they are not interested in paying regularly. They're interested in one big contract that they're going to get in federal government, and then they will just come back to say, I'm paying you. So this is a risk you have to recognize. Because, even big men, nobody wants to take mortgage and be paying on a monthly basis. If you sit, they are just waiting for something that, just the magic to happen, and they just bring the money, bam, I'm just finished paying you. So another issue again is that I think this is a message that also has to come from you to the mortgage banks, which is servicing capacity. Servicing capacity, it's a key element of what you're doing, because I will want to suggest that, you guys will have to start thinking about, maybe not you directly, maybe mortgage banks have to start thinking about having servicing companies that will take up the responsibility of collecting the mortgages for them, so that they can service whichever bond that they're going to invest in. So I guess these are some of the things.
Thank you. If I do forget, you remind me, but I'll touch on go down. Servicing. Actually, what we've agreed is that there are two ratings that we'll be looking for each participant. One is the credit rating, but actually more importantly, the servicer rating. So every institution would have to have a servicer rating. In other words, how good are you at doing this job? So that's that. Before that, you mentioned the issue of employment or?
NHF.
NHF, okay. Now, and I smiled. The reason I did is this. You see, that NHF matter is more like a no-go area. Years ago, I had actually advised that thing called NHF be recategorized as a credit guarantee fund. In other words, the idea is that let it sit at the equity of a housing finance capital structure, such that so long as what is being contributed into it is much more than the loss that it absorbs, it continues to be consistent in size, and therefore can provide the equity required to provide any sort of AAA financing structure you require. Nobody help me hear that English till today. And if you also, so you know what's going on, right? Now, the thing is this, we've kind of like left that area to say, you know what, let Federal Mortgage Bank, you know, and stuff, because it's under their purview, you know, and I think they are discussing some restructuring or repositioning of the institution itself. Let them handle that matter, you know, let NMRC, let's try and take the markets in 2 tiers. So let's even assume 15 million and below, okay? Federal Mortgage Bank, manage that matter. 15 and above, NMRC, you manage that matter. The market is big enough, quite frankly, for 2, 3, 4 institutions, truth be told. Okay, so I hope that answers that area. And then, as you said, you know, that can now be structured, whether you ask for more contributions or whatever, but I won't lie to you, my dear brother. If you ask anybody, say, go add 8 penny, not kobo, 8 penny, half penny, to that thing, you say, well, I have no interest, because the track record has been bad. You know, so that's been the issue of that area. So it's not one that I really dwell on too much.